First up, the Stanlib Africa Direct Property Development Fund has recently been launched and aims to deliver an internal rate of return of 25% per annum. The fund is also targeting to achieve first-year yields on development costs of between 12 to 14% per annum by investing primarily in retail developments in East and West Africa. Manager of the fund, Roberto Ferreira, joins us from Cape Town to describe the opportunities the fund aims to exploit. Good evening, Roberto, and great to have you with us. We're obviously very...
Hi, good evening, Ron.
We hope it's a little bit warmer in Cape Town. It's very chilly here in Joburg at the moment, but I think we wanted to get some insights from you around what this fund aims to achieve and exactly what it's going to be doing. So we've given a little bit in the intro there. Just take us through, this fund is going to be actually developing physical properties and then tenanting them and then holding them. Is that the plan?
That's correct. It's a private equity style fund focusing on development properties in East and West Africa. It's mainly retail developments that we're looking at. The fund size is targeted at 150, and we have seed and anchor capital from the Liberty Group of a third of that. So we can start mobilizing, and so we are developing and fundraising simultaneously. So the primary markets we're looking at are Nigeria, Ghana in West Africa, and Kenya, Uganda in East Africa. But we are opportunistic as well. If we see opportunities elsewhere in Africa that make sense for us, we can explore those as well.
Roberto, just to come to the obvious question, why a fund of this nature at this time? And what specifically in those countries have you seen that has motivated you to get going in the countries that you've just described there, like Nigeria and Ghana?
Well, I think everybody speaks about the growth rates. We recognize that they are real, they are exciting, but furthermore, Stanlib together with Liberty and the Standard Bank Group in general have a full suite of skills to develop projects. So we've followed the group into these regions, into these particular countries, because we have a strong presence on the ground there, and we feel that will help us in maximizing these developments in all respects, in terms of relationships on the ground, in terms of our due diligence aspects, in terms of getting lenders comfortable with what we're doing. And of course, we are also following our South African customers and people we have relationships with, our anchor investors, our anchor tenants in these developments, the likes of ShopRite, etc. And those are the primary reasons for focusing on these regions.
Just to get that right, so obviously you plan to launch the fund or capitalize the fund fully with about $150 million US dollars. What sort of bank lending are you using on top of that to bring these developments to fruition?
Right. The fund itself will not be geared, so it's an equity fund, although we do have the ability to do some mezzanine if required. But we will gear the underlying projects to seek the returns that we need to achieve, that we are selling to our investors. We're looking at the average gearing of between 50 and 65%, depending on the scheme. And we are encouraged by the appetite that's been displayed by lenders so far. We've had various meetings with South African lenders, competitors, and our own lenders within our own group. And they have some good appetite for these projects, and we're looking at international lenders as well.
Roberto, just sketch the opportunity for us. I take from what you've discussed already is that a lot of what you're going to be doing is almost at the request of some of the big retail companies, the big food companies in South Africa, so the likes of ShopRite and Pick n Pay. Just take us through that at the moment. Are the local food producers and food retailers really increasing their scope on the continent quite aggressively at the moment, and that's one of the opportunities that you aim to fulfill with this fund, is catering to properties that they will ultimately tenant?
Absolutely. We've done some research in a country like, in a city like Lagos, Lagos has two centres of approximately 25,000 square metres, servicing the official number of 10 million people and the unofficial number of 21 million people. And to put that in perspective, if you compare that to the likes of Sandton City, that is about 1/8 the size of Sandton City. So there is a huge demand in these countries for retail space. We estimate that Lagos is shy of about 3 million square feet of retail. Now, the likes of ShopRite, Africa features more and more in their revenue stream going forward. And I think to the extent that by around 2030, Africa will contribute approximately 40% of their overall revenue stream. Just in Nigeria alone, they estimate that they can build in the hundreds of outlets, be it in retail developments or standalone boxes, big box type developments. So, the opportunity is to follow these retailers. Our obvious relationships are with the likes of ShopRite, Pick n Pay, etc. But we are seeing some interest from European suppliers and traders coming into these markets, and they are prepared to enter into long-term leases. So it's a really interesting space for us.
You said 60 to 80% of the portfolio will be invested in retail over the next few years. We'll get to the time frame of that just now, but I just wanted to ask you in terms of the other opportunity you identified is obviously commercial as well as the hospitality opportunities. So just take us through what kind of properties you're going to be developing in that space.
Well, as you said, the focus of the fund is primarily on retail space. That is our key area of expertise. But we're also interested in office space as well. And Lagos, again, is a good example. It commands, on average, around $85 a square metre, which is about 4 times the price of office space, A or P grade office space in Johannesburg. And that's attributable to the massive demand. So we see that as an opportunity to capitalize on. There is a severe shortfall of quality office space in these markets. The kind of deltas are not that apparent as stark as that in Lagos, for instance in Accra and Nairobi and Kampala, but the yields are still there. So, and in terms of hospitality, again, massive demand for business hotels, and we are seeing, the biggest challenge with hotels is the operators normally don't like to enter into leases. They're looking for the management contracts alone. What we are seeing is that in order to unlock that, they are prepared to underwrite leases for some of the owners. So they're bringing solutions to the table which make these schemes bankable and investable, and provide the returns that we're looking for.
I think just in terms of just understanding that model, how these hotels work. So what you're saying is essentially the hotel group will come into the region, into a city. They'll want a property. They won't actually build the property, but they'll just get the management contract to offer the hospitality services to clients. Is that essentially how these models work?
That's correct, but unfortunately that creates an issue in terms of the bankability. So they are now preparing to, we've seen evidence and overtures in this respect about them wanting to underwrite leases, which unlocks the entire financing of these projects. So, bankers are prepared to gear, and investors such as ourselves are prepared to take equity stakes in these things.
We also just wanted to understand a little bit more around how quickly this fund is going to be deployed. You've identified the regions already. I mean, how far are you down the road with actually identifying properties, getting building plans passed, et cetera, and how quickly do you expect that money to get put to work?
Well, as I mentioned earlier, we are in business development mode. We're well entrenched in several projects in West Africa. We have exclusivities on some of them. We've got the heads of terms, heads of agreements, etc. with some of them. those permitting issues are largely dealt with already. The fund has a 4-year investment period. So what we're doing is fundraising on the one side and moving capital into these projects on the other side. So it's a simultaneous process. So the $50 million that's been committed by Liberty can be drawn down at the moment, although the first close has not been achieved. So we think it's a compelling case for investors if we present them with an investment case with live projects and not just pipeline projects. And we have teams in, well, certainly in Kenya, we have a team there that is in business development mode. But it's in West Africa that we're seeing a bit more activity, and we've got a bit more of a toehold in there at this point of the fund.
Potential investors will obviously be very interested to find out. We've seen obviously rental escalations in South Africa slow over the last few years as the economy's sort of calmed down. But what sort of rental escalations are you going to be looking for in some of these retail properties in East and West Africa?
Yeah, I think that's a great question. I mean, that really is at the core of this business decision, because in terms of entering into these markets, we have to ensure that we have dollar leases or dollar-denominated leases. So that implies a dollar CPI in terms of escalation. What we've gathered from the market is that some of the current developments, the landlords have demanded higher lease rates than market, and that's put pressure on the traders, and that's now coming back at them, and there's pressure to reduce these lease rates. So there is a recognition that we need to be careful in terms of the entry yield that we expect and the associated escalations.
Great, Roberto.
So we're looking at around 3%.